Last week I sat down with someone to look over his disability coverage. He knew his monthly benefit down to the dollar. He knew how many years it would pay. He knew what his premium was. Then I asked him, what does this policy not cover? And the room got quiet. That quiet is the whole reason for this video. Two of the most important parts of your disability policy are the exclusions and the limitations, because those two sections quietly decide whether you get paid or you get a very polite denial letter. So let's talk about that. Hi, I'm Vlad Schaefer. I'm a financial advisor with Forest Hills Financial Group here in New York City. A big part of what I do is help people understand their real financial risks. And when it comes to income protection, one of the most overlooked risks is simply not knowing what your policy actually doesn't cover. Before we look at the details, it helps to know why these sections exist at all. Insurance, in order to work, relies on a law of large numbers. No one knows if you personally will be out of work next year. That's an individual coin flip. But across 10,000 people of similar age, occupation, and health, the picture becomes more predictable. The insurance carriers cannot know who will file a claim, but they can pretty accurately predict how many people will. Actuaries use this predictability to work backwards. They calculate expected claims, durations, and costs, and then set premiums. Your premium does not buy a prediction about your personal outcome, but it buys you a seat in a group where the total risk is predictable. This mechanism only works when the risk is completely unknown at enrollment. If a loss is already present or foreseeable, you're no longer sharing a risk. You are scheduling a guaranteed payment. This is why insurance carriers draw a line and exclude certain categories or conditions. It's not to be difficult. The foundational math fails if the pool pays for known outcomes. So let's start with exclusions. An exclusion tells you where your policy stops. It names a specific situation and says, this one just won't be covered. The one you will almost certainly run into is the pre-existing condition provision. It deals with anything you had, were treated for, or showed symptoms of before the policy started. A contract will typically exclude self-inflicted injuries, war-related disabilities, injuries sustained while committing a crime, and sometimes specific hazardous activities. The exact wording always comes down to your contract. Then there is the named exclusion. This is the one that surprises people. Say you hurt your shoulder a few years back. You healed and recovered. You applied for coverage and you got approved. The policy might cover you fully for almost anything. A heart attack, a cancer diagnosis, a car accident, but it can carve out one specific thing, that shoulder. So if that shoulder is what eventually stops you from working, the policy that excludes that shoulder would pay for anything like a heart attack, but it pays nothing for that one. But a named exclusion isn't random. It comes out of underwriting. The insurance company looked at your medical history, found one specific thing, and made a decision. And that decision had options. They could have declined you outright, they could have charged you more, or they could cover you fully for everything except for that one item. So an exclusion is often the reason you have the policy at all, which leads to something worth knowing. On some contracts, an exclusion can be reconsidered after a stretch of good health with no treatment or recurrence. It isn't automatic, but if you have been clean on that issue for several years, it's a conversation worth having with whoever wrote the policy. Now, limitations work differently. A limitation doesn't shut coverage off. It sets terms for how a certain kind of claim is paid. The classic example is mental health and substance-related claims. A contract will often cover those, then cap them at a 24-month limit, even if you still can't work after that. You'll see a similar structure around conditions that are hard to measure on a scan, like chronic fatigue, fibromyalgia, certain soft tissue injuries. The policy sets out how those claims are documented and evaluated, and sometimes how long they'll pay. And go back to that shoulder for a second. Instead of excluding it outright, a contract might limit it instead. The shoulder is covered, but just not in the first 12 months. Get disabled from it inside that window, and no benefit is paid. After that, the limitation lifts, and the shoulder is treated like everything else. And here's a simple way to hold the difference. An exclusion is just a closed road, and a limitation is a speed limit. Exclusion means never, and limitation means not yet. Let me put that in practical terms. Two people, same carrier, same benefit amount, same monthly premium. The first one has a shoulder exclusion. 14 months into the policy, the shoulder gives out and he cannot do his job. He files, the claim is denied on that specific condition. The second one has a 12-month limitation on the same shoulder. Same injury, same timing. 14 months in, he's past that window, the claim is paid. One word of difference in the contract, two very different years for those families. So pull up your policy. Take a look at exclusions and limitations and read them. As you read, don't just ask, am I covered? Ask the sharper question, which risks have I actually handed to the insurance company and which ones am I carrying myself? Then check four things. First, your pre-existing condition clause and its look-back period, usually the 12 to 24 months before your coverage started. Second, whether there is a named exclusion on your contract and whether it can be reconsidered after a period of good health. Third, any lifetime caps on mental health or subjective conditions and how long they run. And fourth, your elimination period. That's the waiting period you chose before benefits begin. Look at that number and then look at your cash reserves and make sure that two of them actually line up. And the risk that stays with you is not a dead end. It's a planning question. If your shoulder is excluded, for example, that's a reason to look at how long your reserves would carry you, what your spouse's income covers, whether there is group coverage that fills part of the gap, and what happens to your obligations if that income stops. That's exactly the work I do with my clients using the living balance sheet, looking at how your income, your assets, and your obligations hold up together under stress, not just your policy on its own. If this was helpful, hit like, subscribe for more straight talk on protecting your income and other topics, and drop a comment telling me whether you've actually read your own exclusion page. And if you want a second set of eyes on your coverage, email me at vlad.schaefer@fhfg.com with the subject line Protection Review. I will look at what you have, show you what's protected and what isn't. No obligation, just clarity. Thank you for watching and I'll see you in the next video.